Well, IT sector is the key talking point in the market, and the reason is we have seen a sharp decline after Infosys managed to disappoint the street. So not only the FY23 guidance was a miss, FY24 a very tepid guidance coming in, target price cuts to the tune of anywhere between 5 to 30%, and we've also seen a bit of derating happening given the multiples have been coming off sharply as well. But what does this spell for the rest of the IT sector? Let's try and decode that with Nikunj Dalmia. Nikunj, hi, thank you so much for joining us. Investors are a bit confused. IT companies are always looked at bellwethers, the companies which have solid transparency, solid growth profile, but everything seems to be unwinding at this point of time for them, whether it's demand, whether it's their guidance and the brokerage cuts as well.
So Anisha, there was a time when Infosys would sneeze and rest of the market would catch a flu. And I don't think we are there yet. What you could ask yourself is that what we've heard from Infosys, is that a company-specific problem or is that something which is more like a sector-specific problem? If it is a sector-specific problem, is that as acute as, let's say, what we saw after the GFC crisis? Or this is one of those slowdowns which happened in 2014-15 when the entire digital wheel had changed from enterprise to digital, which was a system, which was slowdown in the system, but it was not a crisis, the crisis in the system. That is what the differentiating factor is. I get a sense that, look, this is 2023 and the dynamics are very different at play. Why the dynamics are different at play? Because IT companies are still getting orders. They may be compromising on the margins.
Yeah.
The cloud adaptation is something which is real, and the cloud adaptation is something which I think will continue. The problem what happened, Anisha, was that post-COVID, this entire sector in a sense went through a period of sugar rush. Everybody changed the terminal value, and when the terminal value got repriced, we saw massive P expansion in some of these sectors, and the growth was in a sense the 3-year order book became an 1.5-year order book, and a 1.5-year order book became a 6-month order book. Everybody wanted to execute very quickly, and that in a sense made the growth look very compressed. So growth was compressed, there was infinite capital in the world, and P multiples expanded. That entire theorem of compressed growth, which everyone thought is permanent growth, easy liquidity because of low interest rates, and re-rating of the stock in terms of P multiple, all of that entire, if I may say, merry-go-round. हम बचपन में कहते थे ना रिंगा रिंगा roses. That merry-go-round, that ringa ringa roses has come to an end now.
Do you think it's come to an end and there'll be like a derating from here on, or at some point of time these are growth companies we have talked about, and if you take a medium to long term horizon, there's still the companies which will end up giving you a CAGR of 10 to 15% per annum?
See, 15% I think may not really work because you also have seen a large part of rupee depreciation.
Yeah, play out already.
So that rupee depreciation may not be at play in FY24 and FY25. So you got to take that 2-3% outside in terms of margin picture. The growth is going to be in 8 to 10% or 10 to 12% depending on the company we are talking about. It will be a while before they can go back to their margins which were the post-COVID margins. So you will have a slowdown in some of the stocks. So when you're buying IT stocks, you got to buy with a narrative that these are businesses which will not contract, but they will grow 8 to 10%. These are businesses where the terminal value will keep on changing because of buyback, and there are very few companies in the world which have this kind of an cash flow, high quality of corporate governance, and 8 to 10% growth, which you can actually, on a conservative basis, forecast for next 2 or 3 years. Now, it is good for an investor who's looking for that growth with a comfort of good quality management. It's not going to be in multi-bagger. It is not going to be a sector where you will make 40-50% return in next 2 or 3 years. This is a sector where you have to tactically enter, which is that Infosys has fallen 10% today. Will it fall another 10% from here? Looks unlikely. If it falls another 5%, you buy. After today's fall, you don't sell. That has to be done case by case. I guess TCS is unlikely to see an expansion in P multiple. But Tech Mahindra, if there is change of guard, which it is, and the exposure to BFSI is less, could make a comeback. So it will be very case specific here, but in terms of that lambi teji in IT, which everyone thought is a permanent reboot in the entire sector per se, that glamorous picture is behind us. So a year ago, it was feeling of a carnival. Now you're feeling like a mortuary. You will settle somewhere in between.
No, yeah, absolutely. The multiples had gone from what 20 times all the way to 35 times. They were
40
hiring
times,
people to
50
the tune.
times.
Yes, for the mid-cap IT, almost 50 times for the likes of LTTS, and the hiring was to the tune of 35,000 people per quarter, which is usually the annual target. So that sugar rush was definitely there. But I also want to glean into your experience of looking at Infosys versus TCS. The talk was that Infosys has been overshooting TCS's growth for the last 4 years. Now that seems that it's going to turn. Plus, there is some leadership change at TCS as well, which is a bit of a negative factor if you have to put it that way. Where do you see this TCS versus Infosys, going forward? Do you think the kind of multiples will continue to be same? They'll narrow, they'll expand? What's your take?
No, quarter ago I would have said that TCS P multiples had peaked out and Infosys was catching up. But Infosys also has seen exits. They've lost some talent.
Yeah.
They've not been able to replace it very convincingly. See, typically when you get P multiples are a function of growth visibility. Salil Parekh, when he came, he gave you that comfort of growth visibility. But these numbers have got a lot of question marks about his ability to predict his own business. See, as a manager, you will always go through cycles. Any business will go through 5 cycles and markets will forgive you for that. Markets would say, okay, we assume this growth, but macros are bad, the growth cycle has got punctured. Where markets are taken aback, I mean, why is that you've seen a 20%, 15% fall is because you've came out after Q3, you increased your guidance. You increased your guidance. You've come out after Q4, you've decreased, you missed your guidance and you've reduced your guidance for FY24 almost to middle single digit. Which means the management is not giving you consistency in terms of growth. And when the consistency of the growth, Anisha, misses, the P multiples will always get smashed. There is a reason why commodity companies don't get P multiples of 50. There is a reason why Asian Paints got a P multiple of 70. Excess. But markets will always give you excess multiple when they get comfort, clarity, and a communication which, when you make a communication, is not very different from where you deliver. What Infosys has indicated that right on the top, in middle of the slowdown, they came and said that we are going through the honeymoon period.
Yeah.
What we realized that when the tide turned, you figure out who was naked.
Absolutely. Okay, so thank you, Nikunj, for joining us and giving us this insight when it comes to the IT sector. Very precariously placed at this point of time. We have seen the reversion when it comes to the multiples as well as growth is coming down. But is it going to be a one-quarter phenomenon or a one-company phenomenon, or will it be more structural in nature? We'll wait by and see more on that.
If you like this video, then like, share and subscribe to ET Now.